Alright, this is Bob Joyner, and in this video I want to talk to you about averaging down, both the pros and the cons of doing that. So I know that a lot of people average down, or what some people call dollar cost averaging, but if you're not familiar with it, let's take a quick look at a chart and talk about what it is. This yellow circle, for example, right here on this chart of iTech, and this is a 2-minute chart, recent chart of iTech. And let's just suppose, for example, that a trader made an entry right around this price here inside that yellow circle. And you can see where price goes up a little bit. Perhaps the trader was getting into it because they saw momentum going up there. And then all of a sudden we see where price kind of hits its head and comes back down. So let's say that the trader does not take profit, and then all of a sudden they find themselves in a losing position. So what a lot of traders will do is, rather than stop out of that trade, they will enter a new trade and create an average price. So for example, let's say price continues down, as you can see, down to 1340 and 1350. Let's say they make a new entry in there, thinking, well, I don't want to lose on the trade, so let me buy some more. So let's say they bought 100 shares up in here, and then they bought another 100 shares down in there. Well, the idea is that you add those two positions together, you divide by 2, and you get an average position of 1380. So as long as the trade comes up above 1380, then the trader can make a profit. As you see in this case, the trade does not come back up to 830, almost gets there. And what would happen with most traders is that even though it gets close to break even, they're thinking it's going to keep on going, this is all going to work out, I'm a happy camper. And then what happens a lot of times is that price is not, and then rather than taking a very tiny loss right around in here, they hold on to the trade again, hoping it's going to work out. So that's kind of like one of the problems of averaging down overall. But let's take a look at some other things. For example, the pros and the cons. Let's just kind of lay them out there. So there's no such thing as a perfect entry on the pro side. Okay, we acknowledge that. And that's one reason that some people believe in entering multiple positions on the same stock, is because there is no such thing as a perfect entry. Trend following allows multiple entries, and this is true. So most people use the term dollar cost averaging when they're talking about multiple entries on a swing stock, swing trade, and it's a little bit less risky when you're doing it there, because there is such volatility within a stock's price from day to day, depending on the market, depending on news events that morning, that sort of thing. And the other pro is that sometimes it works out, and that can also be the bad part of it, is because sometimes if it works out, it doesn't always work out. It's not really a strategy, it's just a kind of a happenstance type thing. So looking at the cons over here, the problem with it is that your position sizing becomes skewed unless you're using like half position on each of the two separate trades. Then you're actually doubling down, as they say. You're actually entering a two-size position for a trade that's not working out. And when you phrase it that way, it kind of makes sense that this doesn't make sense. The other problem that I have with against averaging down is that I think it encourages sloppy trading, because mentally you're thinking, well, I can always average down, right? Well, if you think that way, then the problem is that you will tend to do it more, and that you will tend to be more sloppy in your entries. I just happen to believe that. You can disagree if you want to. The third point is that second positions are often emotional. They're often not based on any kind of technical support or resistance. They're just an emotional reaction, kind of a knee-jerk reaction to things not going our way, and so we enter a new position, and a lot of times those positions are emotional based, not technical based. So that's another problem with that. So some questions for those who do average down. Does averaging down work for you? And the only way you'll know that is by doing some statistics and looking at the trades where you have averaged down, and overall, does it work out? Are you making money, or are you losing money on those deals? Second up, does averaging down encourage sloppy trading for you? Now, it may not for everyone, and if it doesn't for you, great. If it's a very disciplined part of your trading, then hats off to you. But for most people, I think it encourages some sloppy trading because their focus is taken off of the technical aspects of the charts and the trade. Third up is, what is the psychological impact of averaging down? And what I mean by that is most people, if they're in a losing trade, they're already stressed enough. And then if you double down, if you add to that position, you're doubling your stress if it moves against you, because now you've got not just one position, you've got two positions going against you. And it can be very threatening to a trader psychologically. It can erode their self-confidence as a trader, which is very key when you're trading. Fourth question: would a stronger focus on support and resistance work better for you? And the reason I say that is because I strongly believe that support and resistance is paramount to a foundational aspect of trading. And a stronger focus on that, I think, a lot of times would help you just go ahead and take the stop, rather than let the trade move against you. So coming back to this chart of iTech here, for example, and looking at it through the end of the day, what happened? As you can see, it came back up close to 1380, as I mentioned, and then just tumbled in price. So let's say if you had doubled down and then you didn't make your exit when it came close to 1380 and close to break even, and then you're down. Now what are you going to do? Are you going to hold that trade overnight hoping it works out? That's what unfortunately a lot of traders will do. They'll let that day trade become a swing trade, and we never know what's going to happen the next day, right? Now, another thing that you can do is, like I said, you can use aspects of technical analysis to help you make your trade decisions. So initially, for example, if the trader had gotten into there, that wouldn't be really a great entry price, because we're coming up into a known area of resistance, which is the pivot line in this case. And down in here, there's really no area of support. It bounced a little bit, but there was no really area of support at that price entry of 1350. If you were going to double down, the logical place to do it would be at a known line of support, such as the S1 line we see there. In that situation, that trade may have had a better opportunity working out. Another bit of analysis we could do is just looking at channels, and as you can see, this is actually in a downtrend, so the preferred entry on this trade would be a short at those lines of resistance up in here and on the previous day's closing price there. Those trades would have had a higher probability of success because they would be trading within the channel, the short-term trend channel for iTech. Now overall, looking at this stock on a longer term basis, it is still contextually a long trade based on this. I'm recording this on the 9th of August 2015. But on this short term basis, over the past couple of days, we have seen a retreat in price, and just posting some trend lines here makes that pretty obvious on the trade. So if you're interested in learning more about support and resistance, I do have a 6-episode video mini series, if you want to call it that, on support and resistance. So it's 6 videos. It's free. And if you go to that URL that's posted right there on the screen, you can go and check out that series. I also have a couple of other series there as well, and perhaps that will help you make better trades. One of the things that I talk about in the chat room that I lead is that a lot of times when I'm talking about a trade, I'll talk about what is the basis for the trade. Well, the basis for the trade a lot of times is going to be based upon areas of support and resistance. So the more that you can see those possible areas of support and resistance, the better your trades can be. And then if the trade moves against you, you simply take a small loss on the trade rather than holding it as it moves against you, because you can always re-enter the trade. There's also a fuller article on this very subject at startdaytrading.com if you're interested in this subject.